while we invest independently, once we invest, the founders have access to all of us. And so each of us have these different skill sets and networks that we put to use for the portfolio. But when you peel it back, there's a lot of other things. Investing's a lonely sport. Fundraising's a lonely sport. When you can do that collectively, you get the power of three individuals who have different styles, approaches, and networks. The whole is greater than the sum of the parts. And we see that across a lot of dimensions. The last thing I'll say is the diversification. This is both for ourselves and for our LPs. If each of us were going to apply this model and let's say each make 5 investments a year over 3 years, each getting 15 investments for a fund, collectively we now have 45 to 50 investments per fund. We get this really nice diversification for our LPs. It's a really interesting portfolio construction, and for ourselves, where we're basically buying risk within each other.
So welcome to the Slice podcast, where we uncover the stories of fresh emerging managers across the early stage venture landscape. You are the co-founder and general partner of 43, pre-product fund that puts founders in business by leading their first $500,000 to $1 million round of financing. Before we get into your strategy and thesis, let's take a step back and let's start where we always like to around here, which is, did you always think that you were going to start a fund one day? Was this always the plan?
I grew up in northern Minnesota, far away from all things technology, like literally farm town Minnesota. I grew up working on farms. But luckily, my dad lived out in the Bay Area. So I got exposure to the technology world through coming out to the Bay Area over summers. As soon as high school was done, I moved out to the Bay Area. And yeah, that was my entree into Silicon Valley and all things technology.
You've been a founder. You started a pretty successful growth marketing agency who compelled you to join forces with your partners today and build this fund. Why do we need another early stage venture fund?
Yeah, this is interesting. I went to Berkeley. As soon as I came out of Berkeley, I joined a small digital marketing agency. And there was something helping companies figure out how to grow that really resonated with me. Did that for a couple of years, tried my hand at doing my own startup. That ultimately failed. Coming out of that, I knew I wanted to continue working with founders. I wanted to build a growth agency. I combined those past two experiences and built Growth Pilots, a growth marketing agency. We worked with Instacart, Gusto, Zapier. We managed hundreds of millions of dollars in ad spend, successful through and through from that lens. But really what it taught me is I love client service and working with founders. I started angel investing on the back of the network and the skill sets I was building when I was building Growth Pilots. I met Dustin, my partner at 43, along the way. He was running a fund called Maiden Lane Ventures at the time, and Maiden Lane's it sat on top of AngelList. It was kind of like a fund of funds that would back syndicate leads on AngelList. I was just angel investing directly and in other people's AngelList syndicates. And Dustin's like, you should start a syndicate. And, he kind of nudged me. And we met at a dinner he hosted in 2015. And that was when things took shape. I started a syndicate, went through the process of finding investment opportunities and raising capital for them in an SPV format. And that was a great learning experience. Ironically, I learned a lot of things. I guess I built some of the wrong muscles, and I think that was like a big part of the learning. SPVs are very FOMO driven. You have to sell the signal of the deal to raise capital. And what I learned is I absolutely hate that style of investing. And so what I found myself doing time and time again, I'd find this really promising founder and they were ridiculously early. And I'm like, man, I'd love to invest, but it won't work. The market demand is not there. You haven't launched a product. You don't have a tier one. There's nobody else investing. And so I would just start writing personal checks into these companies and being an angel. That's where I started to feel like, okay, this is much more my style. Believing in founders before there's anything else and really helping them figure out what it's going to take to find product market fit, what it's going to take to raise capital. Dustin and I would partner together on some of these. He'd see opportunities and share them with me and vice versa. By the time that I sold Growth Pilots, I knew what I wanted to do next. I wanted to continue investing. I wanted to do it full time, and I wanted to do it under this format of early before anybody else believes. Dustin very much, that's kind of his thesis as well, or his style. And then we met our partner, Annabelle, who had been an angel. Annabelle was very early at Open Door as the head of people and scaled them from 30 people to 500 plus people. We each kind of took this like very founder first, really underwrite to the founder, don't really care about any other signals other than why is this founder the right founder to build this company? And that's the thesis for how we banded together to start 43.
You guys are known for your hands-on approach with pre-product startups. What is there to put your hands on if there is no product? What does that mean?
Yeah, this is the most common question we get from founders. And they're like, why should we work with you? How do you help? What's special about what we're doing is our model. We're a non-consensus fund. Each of us makes our own investment decisions in a vacuum. We basically take the fund, divide it by three. We each do our own sourcing, our own deciding. And each of us do about 5 investments a year. We're very low volume at the individual level. And what that allows us to do is just have this insane amount of bandwidth and availability for the founders we work with. And so when we say hands-on, it's not super regimented. You pick up the phone, you get a text message from one of us or call one of us. We get back to you right away. Very few people show up like that for founders, especially in those early days. That's really kind of the space that we want to occupy, is really acting as this like always on available partner to help founders go through whatever it is they're going through, whether that's capital raising, a co-founder blow up, thinking through pipeline, even product decisions, a strategy. We really just want to be a sounding board and help unblock founders, leveraging our networks, our brains, our skill sets. And because we have a lot of capacity, because of how few investments each of us do, it ends up being this really special relationship with the founder.
How'd you three come together? Why split it this way? Why not do 3 separate funds? Usually when you have partners coming together, there is some sort of overlap. How did you land on this?
That's a great question. We genuinely enjoy working with one another and value the perspectives and the support that each of us provides. While we invest independently, once we invest, the founders have access to all of us. And so each of us have these different skill sets and networks that we put to use for the portfolio. But when you peel it back, there's a lot of other things. Investing's a lonely sport. Fundraising's a lonely sport. When you can do that collectively, you get the power of 3 individuals who have different styles, approaches, and networks. The whole is greater than the sum of the parts. And we see that across a lot of dimensions. The last thing I'll say is the diversification. This is both for ourselves and for our LPs. If each of us were going to apply this model and let's say each make 5 investments a year over 3 years, each getting 15 investments for a fund, collectively, we now have 45 to 50 investments per fund. We get this really nice diversification for our LPs. It's a really interesting portfolio construction, and for ourselves, where we're basically buying risk within each other.
Fund 1 was 13 million bucks, 40 companies, 250K checks. How did you guys think about the math and the strategy?
We started with $1 million pilot fund back in 2021. This was before we decided to go all in and work together at 43. We wanted to prove out working together. We had been doing it informally as angels. We wanted to formalize it. So we had $1 million angel fund that we deployed, and that went really well. Just the dynamic
and
working together.
Just your own capital?
No,
right?
This was like an angel fund that sat on top of AngelList. So this is external LPs. And so that was the spark that really ignited everything. It really just propelled us forward. We really liked working together, and we're like, let's do this. And so that was 2021, August 2021, we made the decision. We're doing this. We put materials together for Fund 1 and set out to raise. Fund 1 was supposed to be $20 million. The timing of this, I'm sure anybody listening who is fundraising during that period can probably empathize. We had a very fast first close. We started fundraising at the very tail end of 2021, and we're like, this is going to be easier than we thought. And then Q1 2022 hit and the world fell apart. Public markets crashed, and it was like crickets for a year. We didn't even do another close. We waited till early the following year, which is when we did our final close. So yeah, we landed like 13.3 million ended up being our final fund size for Fund 1. And thinking through check size, we really think of ourselves somewhat as an accelerator alternative. The stage we invest at, the amounts of capital these founders are raising, and the terms are all quite similar. And we just believe the support we provide is much more bespoke and one-on-one versus the batch-based approach. We don't negative sell accelerators. They have definitely paved the way. We just think there's founders who a different model resonates more with, and that's really why 43 exists. We wanted to buy enough ownership where we were getting paid for the amount of the time and the work that we're putting in. And so Fund 1 was really focused on buying 5%. We're almost all the way through Fund 1 at this point. Looking ahead, we want to double down on that.
What is the future of the firm? Like, does it stay at this very early pre-product stage, trying to get as much ownership up front with that 250K ticket, or does it scale? I'm sure that when you find a winner, the temptation to kind of follow into that, it's really high. Like, coming from like an SPV background, like I'm sure that you probably consider.
Well, it's funny you bring that up. We have 0 reserves for follow-on, and we don't ever plan to do follow-on from the fund. We want to keep our non-consensus culture, very pure, if you will. We want to buy as much ownership as we can up front. If that's when the cost of ownership is the lowest. If you look at the data on follow-on, it's a very difficult game to get right. We'd rather focus on what we're great at, which is finding great founders before anybody else, buying as much as we can up front, working closely with them and helping them succeed. That's the space we want to occupy. To answer your question on future plans, we will never have like $100 million fund. I think our fund will always stay small. We want to keep the ratio of capital to partner very consistent from fund to fund. Once we find that right groove of buying 5 to 10%, whatever that is, but that's our plan.
Where did you find these deals? What is it? Just like your network, like you're all former founders, kind of like in the space for a long time. Like it's just like referrals? Do you go outbound? Do you try and find people before they even have an idea of starting a company? What's the strategy there?
Yeah, I think it varies for each of us. It started out being very network driven. We didn't have a brand. Nobody knew who 43 was. We were still figuring out our own strategy. I think now we have the semblance of something like a brand coming together. And we're not loud. When I say brand, I mean people will hear and see the work that we do with our founders and other investors that we collaborate with. I think there's a word of mouth brand shaping up. We still see a lot of stuff through our networks. We have a really cool space in San Francisco. The name 43 comes from the space that we have. All credit goes to my partner, Dustin, who during the pandemic leased this big space in San Francisco. We would get together and jam there, and that played a big role in us starting 43. Then the pandemic hit, and we're like, shit, should we just like get rid of this space altogether? Space isn't like nobody's in SF anymore. And he's like, well, let's keep it. And so it ended up being a great asset for us post-pandemic. I was just in San Francisco last week. We had a dinner there. Very common for us to have events there. We have our portfolio companies hanging out and working there. The space has played an interesting role. There's somewhat of an outbound motion to bring founders together for events. The most surprising channel is cold inbound. And so usually this is like the most taboo channel of any adverse selection. It's the worst founders, yada, yada. I think what we've seen, and again, this varies between Dustin, Annabelle, and myself, but I have, I've been a founder before. I think I have a little bit of a more of an online presence, if you will. And that has led to some really interesting inbound. When you pair that with the fact that we operate somewhat like an accelerator alternative, the way that I think about it is an accelerator application is effectively cold inbound. We don't have an application process. We don't position ourselves as an accelerator per se, but founders know what we do. And you look at our website and you can see, you can almost infer that we operate that way. We get so many messages every week, like, how do I apply to 43? Beyond that, I get an insane amount of cold inbound. My last 4 investments were from cold inbound. And I did a LinkedIn post about this a month ago. I said my last 3, and I just did another one 3 weeks ago. That channel is one that I'm more excited about than any because of this accelerator alternative positioning. I think it's a really, really interesting time to be starting companies right now. There are more founders at the idea stage than there have ever been. And so it's really like a filtering exercise. But yeah, that's kind of a long answer to your question around sourcing.
What are your thoughts on accelerators? We have a thesis. We call it the unbundling of the accelerator model, the unicorn factory that you and I grew up in. It's kind of shattered post 21. Abundance of capital, small funds run by emerging managers like yourself are somewhat replacing that first check. I'm curious to hear from somebody who's on the ground in the trenches every day.
It varies. I think I fully agree with the sentiment around the unbundling of the accelerator. There's a stratification in the market. If you're a first-time founder, not super well networked, the accelerator was really your only option. And now I think there's just different founder profiles and there's founder investor fit. Before you didn't have options to choose from. And now with so many different funding options available, I think there are founders who would prefer, who want the support, like the capital and support from an accelerator, that would rather have it from something that looks like a 43, that's more hands-on, it's more high touch, low volume. And that's not everybody. I think if you look at on the whole, like look at the founders who go through YC, tends to be very young technical founders, maybe don't have a ton of work experience. I'm generalizing here, so call me on my bullshit, but I think that's a general sense we see. The founders that we back, that we intentionally look for, they know a problem space very, very well. They're obsessed with a certain problem. They have work experience, and insight that we think empowers them to build a company and gives them staying power. They're not going to pivot to something else if there's a new hot trend that comes out or flavor of the week industry. That's how we think. And there are other funds who I think are at our stage who have similar theses that kind of play on a similar angle. I love the accelerator movement. I think there's, especially the top accelerators, a handful of them that everybody knows are best in class. There is more demand than ever for funding at this stage. So I don't think the accelerators are going anywhere. That's not what we're trying to do with 43. We just think there's should be more selection in the market for founders who maybe are better suited to work with a different model.
How do you diligence those profiles? There is no product, probably first-time founders as well.
There's these three universal questions that all three of us ask. It's why you, why now, and how, right? The why you goes back to what insight, work, or lived experience do you have that enables you to build this company? Why are you the right founder to tackle this problem? Why now? What's enabling this company to be built right now? And how? This one's a little bit more, it's harder to diligence because it comes from somebody telling you what they're going to do in the near term, and you have to really understand what their plans are to execute. I think our secret sauce is just because we go so deep with founders and because we are low volume, we spend a lot of time with founders before we invest. And that allows us to get a sense for their personalities, their working styles. And these things can help you build confidence and conviction in a very short period of time. I think it takes reps. The last investment that I did, I met the founder via Zoom. The next day I flew up to San Francisco, had dinner with him. We spent 3 hours together and then was back in San Francisco a few days later to meet with him again. I really got a well-rounded view of that person, their thoughts on life and company building. And I just like, there's something that it's kind of an intangible that it's hard to put into a rubric, but again, it's that feeling of conviction that allowed me to get there.
Looking back at the first angel check that you've cut and the last investment, what are the main differences in your style of approaching cutting the first check?
I think learning to trust your instincts, I think that's probably the biggest change. I think early on is coming from the AngelList SPV world where you're not trusting your instincts, you're underwriting someone else's signal or another fund's name, and that's the thing that gets it done. Going from that to the opposite end of this spectrum, which is like, I don't care. Ideally, there's not even anybody else investing. We want to be the first check. There's no product in market. Could not be further diametrically opposed, the two approaches. It takes experience. You have to deploy capital. You have to see how things play out. But if we're holding ourselves accountable and honest to the same standards that we hold founders to, it's like, why this founder? Why now? Why me? What do I think about the world and know about the world that allows me to underwrite this founder? And I have to trust that, because if not, what am I doing?
What's a hill that you're willing to die on that other VCs may not see that you're very comfortable about?
So that's an interesting question. Our stage is controversial in itself. It's a kind of an existential question because like most investors and even LPs, like they look at what we're doing, how early we're writing checks, and that there's nothing to underwrite against other than the founder. And I think like my controversial take is that we don't believe that there's really much difference between the stage that we're investing and even the seed stage. There's very little that has changed from a risk perspective, but the price is 3 to 5 times different. So that's the controversial take that's at the center of our strategy at 43, that there is a risk arbitrage between the two, and that there is very little difference in risk between when a founder goes out to raise their seed round and the stage at which we invest.
Talking about LPs that get this kind of game, who's the ideal LP profile to be an investor in 43? How did you get the first few ones to believe in the idea? Starting from that first million syndicate fund that you had, was it just friends and family taking a bet on you? Or was there more to it, a desire to go as early as possible without doing the homework?
Let me answer your first question. The ideal LP profile for us, because we are intentionally constraining the size, like we will never be a large fund. It immediately kind of self-dictates which LPs are going to be a fit for us. Where we've found the most resonance, I think, is there's two groups. There's family offices who have a more sophisticated take or strategy when it comes to venture, where they've been doing this for a while. They can see the wide basket of portfolio construction, and they see what the kind of ultimately what the portfolio math could end up looking like for our fund. That's one. And then two, again, I think it's more of a fund to fund who, I think there's yourselves included, there's like a new crop of fund to funds who are looking for managers with maybe a unique take who are going much earlier and who have this information asymmetry that when there's a breakout, even though we're not investing, I think there's opportunity for more capital to be deployed. And our take has always been we're happy to facilitate that. We just don't plan to make those decisions ourselves. I think those are the two groups that, as we think about how we scale or how we endure. In terms of the first close we did for 43 Fund 1, that was mostly just personal network. All of the folks that I worked with when building growth pilots, I worked with well over 100 founders, and the number of growth executives that I had the opportunity to work with was humbling. And so we tapped a lot of that network for Fund 1. I have to give credit to the year of 2021 as well. People were very loose with their checkbooks. I'd like to believe these folks would still invest in the current market if this were Fund 1 for us.
Yeah, very liquid market back then. Not the same over the last couple of years. We'll see where the weather takes us. Let's talk about the transition from being a founder, operator, cutting an angel check casually here and there, to becoming a fully fledged fund manager. I know you guys run on AngelList. There is a lot of help and support that you've been able to get from tools and the collapsing of the capital stack. What was that transitioning process?
Yeah, that's a really interesting question. First of all, we don't run on AngelList. We built our own fund stack using one-off solutions. I'm a very hardcore operator. Running an agency is no small feat. We were like a 30-person agency. And so just processes and getting things done, execution, it's just kind of in my DNA. And so I know a lot of times there's this sentiment like, oh, when you jump from angel to running, building, managing a fund, there's all this admin burn. I actually find that stuff very, very easy, just because go run an agency who's trying to juggle clients and all of the things involved. You have to be so buttoned up, and there's so much admin stuff that needs to be done. From that perspective, that hasn't been a big daunting challenge or anything. Venture's strange because it ebbs and flows so much, not unlike in the agency world, where some months you'll get this wave of inbound intros of companies that you're talking to about potentially working with. The biggest difference is the feedback loops and the work are just so different. Running a growth agency, especially a growth agency focused on performance marketing, where the feedback loop is literally you can work with a company and same week start seeing if it's working and you get stuff to work with. Whereas there's not really much to work with other than the interim progress that you make. I've taken everything that I learned from running an agency and the high feedback loop, and I've tried to work that into the way that I work with founders, not in an overbearing way, but more in a way that these interim signals pop up. They give you more information and help you adjust the way you work with a founder and share what that founders doing with downstream investors. I'm the workaholic, unfortunately, for my wife's sake. And yeah, I'm like kind of always on 24/7. And that's just like, it's how I'm built. And so I like making myself available to founders to do that work. So from that perspective, nothing's changed.
I know the feeling. There is three of you. You all move extremely quickly. You're all very entrepreneurial and live the early stage hyper growth phase of early organizations. How do you keep all your ducks in a row? How do you make sure there is no overlap, no stepping on toes, yet still being collaborative? You just mentioned you built your own tools and fund admin stack. What's something you've done to facilitate your day-to-day when it comes to collaborating between the three of you and also like managing an early stage fund?
The collaboration, I think when someone's going to make an investment, it will get surfaced. We don't convene as a committee to say, hey, what do you think about this deal? But in general, we know when we're close to making an investment on something, we know there's not really any stepping on toes from that perspective. Quite the opposite. We've had situations where like I'll meet a founder and I'm like, just this isn't a fit for me, but I actually think my partner Annabelle would love this. And I facilitated that introduction and she's made that investment. And so we pass the ball around. That's just part of being a good partner. More tactically, every company that we work with, we do a shared Slack channel with them post-investment. You have access to us when something comes up, it gets triaged very quickly. That's how we manage the workflow for one-off requests and things that founders need. Because we make so few investments at the individual level, this is very manageable for us to triage all the stuff that comes.
Really love what we've been talking about so far. But what is the question that every LP asks that you just want to throw your hands up in the air?
It's adverse selection. This is for our stage. This is the number one thing that we hear. This was tough for Fund 1. We do have some more institutional grade LPs in Fund 1, which we're very fortunate for. But I think one of the big risk areas that we heard from a lot of those individuals were like, okay, well, You guys aren't spin outs from tier one funds. You guys haven't been early employees at any super breakout. Annabelle was that open door, of course, but I think we look like a ragtag band, and we like that. Like, this is who we are. We've all had these interesting experiences and deep networks. We look like non-consensus fund managers. The obvious question we would get, given how early we were investing, just for context, our median entry point on fund one is $5.5 million post. When you tell that to somebody backing these Silicon Valley based funds, the median pre-seed entry point is probably closer to like 12 million post. And so it took us a while to understand that. And we had a little bit of imposter syndrome ourselves. What we realized is objectively, we are investing earlier than the vast majority of funds who call themselves pre-seed funds. Most pre-seed funds are looking for a product, some traction. We're willing to take that risk because, again, we believe that the risk is not that different between investing at the idea stage when you can underwrite to a strong founder versus one or two jumps later. And so I think it's that element and how quickly we move. I think that's another thing. Because we're non-consensus, each of us makes our own decisions. We don't have a committee. We don't have to put on these optics. We're not writing like a big check that would necessitate us having an investment committee, but also like convincing our LPs that there's like some rigorous diligence process. We're just finding great founders who we believe have some unique insight, who are building into a strong trend with a strong why now. And we're being very selective about it, with each of us making 5 investments a year. The next is just kind of looking at our SOI and looking at how many of our portfolio companies have raised follow-on capital from the quality of funds who are investing in those funds and at the markup. Luckily, we're most of the way through fund one, and we can point to it and say, if it's adverse selection, then look at the funds who are buying that. That is definitely the most common question we got in fund one. Great question.
This is great. Honestly, what you're talking about is what we would love to see more managers do. Because like, it's not true that, you know, that 5 to 10 mil in terms of cap doesn't exist. I think it does. And it just requires a little bit of guts and the right network to tap into it. The returns are there. And if you go back 15, like 20 years, and you look at the best returns of all time, those companies were not funded at a cap of 30 posts.
Yeah.
It just doesn't work like that.
Yeah.
And even the ones that are funded at the tune of 30 posts for a seed round, I can assure you that there are folks in there on that cap table already, and they were there sub 10. And you just missed out. Welcome what you guys are doing. I salute you for this great work. I honestly wish there was more. I don't think that there is that many. Even us talking to emerging managers all day, every day, I would say less than 20% of the set is actually aiming for sub 10, and less than 10% of the set is aiming for sub 5. And I can see why you say that people are often questioning those choices, those people's choices would be like, hey, you're doing sub 5. You don't have what it takes to actually underwrite that. But then the people that have what it takes would never do a sub 5 deal because the risk is too high, and they can go higher, they can raise bigger funds. And so there is this asymmetry, this inefficiency in the market that we aim to fix. I think your strategy is going to pay out really good dividends over time.
Yeah. Well, just one last quick thing.
Yeah.
I think a lot of this stuff is systemic. The need to grow just because that is the natural inclination of what fund managers do. That's why you don't see as much at this early stage. If you have a $100 million fund, how many checks do you have to write at sub 5 million posts? How much work do you have to do? The market gets set by the amount of capital that's available. And when you have these funds raising, it changes the dynamic of what a seed round looks like and what that first round of capital looks like. This is where we're like hard line in the sand. We are not going to get pulled up to doing that. The work we want to do is at this stage. And so we're going to take it on the chin for management fees, but that's not why we're in this. I think that's where you get the true intentions of what we're doing, and the conviction that we have in our stage is like, look at the fund size.
Fund size is your fund strategy. If you want to go early, you have to have a small fund. Yeah. That's as simple as it gets. And most LPs don't understand this, but like it is literally what it is. Like, so thank you so much. This was great. Great conversation.
You've just listened to the 3rd episode in the 3rd season of Slice, the podcast for emerging managers. Thank you so much, Soso, for joining us, and thank you, Walter, for introducing us to Soso. Everybody hold their bananas for next week, because we have Turner Novak of Banana Capital joining us to share his journey into becoming an emerging manager. We'll see you then.